What if your money could start working for you instead of sitting idle in a bank account? Many people assume you need tens of thousands of dollars before passive income becomes possible. But that's not necessarily true. Thanks to ETFs, investors can gain access to diversified portfolios, dividend-paying assets, and long-term growth opportunities with relatively small amounts of capital. While $1,000 won't generate life-changing income overnight, it can be the starting point of a system designed to produce cash flow and compound over time. Today we will talk about turn $1,000 into passive income using ETFs. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Understand what passive income really means. When most people hear the words passive income, they imagine money appearing in their account every day without any effort. The reality is much different. True passive income usually requires either time, money, or both to build. A $1,000 ETF portfolio will not make you financially free overnight. But it can become the first step toward creating a system where your money has the potential to generate returns without requiring you to trade your time every single day. The purpose of starting with $1,000 is to develop the habits of investing, understand how financial markets work, and build a foundation that can grow over decades. 9. Build the foundation with broad market ETFs. The first priority when creating a $1,000 ETF portfolio should be diversification. Instead of trying to predict which individual company will become the next big winner, broad market ETFs allow you to own a small part of many different businesses through a single investment. These companies can operate across various sectors such as technology, healthcare, finance, manufacturing, consumer goods, and communication services. This reduces the risk of relying on one company's success and allows you to participate in the growth of larger parts of the economy. 8. Allocate a portion to dividend-focused ETFs. If the goal is to create passive income, dividend-focused ETFs can play an important role in the portfolio. These ETFs invest in companies that distribute part of their profits to shareholders through dividends. A possible strategy would be to allocate a portion of the $1,000 portfolio to dividend-oriented funds, while understanding that dividend payments and yields can change over time. The income may seem very small in the beginning, but the purpose is to start the process. By reinvesting dividends, you can buy additional shares that may generate future dividends, creating a compounding effect. Over many years, consistent contributions and reinvested income can potentially turn a small investment into a much larger source of cash flow. 7. Add growth ETFs to increase future income potential. Many beginners make the mistake of focusing only on immediate income. A $1,000 portfolio is still in its growth phase, which means increasing the value of your investments can be just as important as receiving dividends. Growth-focused ETFs provide exposure to industries and companies that may expand faster than the overall market, including areas such as technology, artificial intelligence, cloud computing, semiconductors, and other innovative sectors. These investments can experience greater volatility, but they may also provide opportunities for long-term capital growth. 6. Consider international ETFs for global diversification. Many investors concentrate all of their money in a single country's stock market, but businesses and economic opportunities exist around the world. Including international ETFs can provide exposure to companies in developed and emerging markets. Different regions can perform differently depending on economic conditions, technological advancement, consumer demand, and government policies. 5. Reinvest your earnings instead of spending them early. One of the biggest mistakes new investors make is expecting their first few dollars of passive income to immediately improve their lifestyle. A $1,000 ETF portfolio may produce a relatively small amount of income in the early stages, and spending those payments can slow down long-term growth. A smarter strategy for many investors is to reinvest dividends and any other returns back into the portfolio. This allows your investment base to gradually increase, which may lead to larger future income. 4. Add new money every month to accelerate growth. The biggest secret behind building significant passive income is not choosing the perfect ETF, it is consistently increasing your investment amount. Someone who invests $1,000 once and never contributes again may see growth over time. But the process can be much slower than someone who continues adding $50, $100, or more every month. Regular investing allows you to purchase additional shares during both market increases and declines. Over years and decades, those continuous contributions can have a much greater impact than trying to find the perfect time to invest. 3. Ignore short-term market fear and stay consistent. The stock market constantly moves because of economic news, company reports, inflation concerns, interest rates, and global events. New investors often become emotional when prices decline and may sell their investments out of fear. However, market fluctuations are a normal part of investing. Long-term investors understand that temporary declines do not necessarily change the value of a well-diversified strategy. The ability to remain calm during difficult periods and continue following your investment plan is often one of the most important skills for building wealth over time. 2. Create a system that works for decades. The most successful passive income strategies are built like machines that operate continuously. The system is simple. Earn money, save a portion of it, invest in diversified assets, reinvest the earnings, and repeat the process year after year. Many people search for complicated strategies, but the foundations of wealth are often surprisingly straightforward. The challenge is not understanding what to do it, is maintaining the discipline to continue doing it during good and bad economic periods. 1. Turn $1,000 into the beginning of financial freedom. The greatest mistake investors make is underestimating the power of small beginnings. Your first $1,000 may not produce enough passive income to pay your bills today, but it represents the start of a wealth-building journey. By choosing diversified ETFs, balancing income and growth, reinvesting your earnings, adding money regularly, and allowing time to work in your favor, you create a system where your money can potentially work alongside you. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.